Hello everyone, this is Chandraprakash Joshi and welcome to ixamBee. Union budget document is very important for many exams like RBI Grade B, NABARD, bank exams, UPSE, and in most of the competitive exams you will find some of the questions from union budget. So it is very important document and you need to thoroughly understand this. Here I am presenting a series of the video on this because one video covering the entire union budget and economic survey will be too lengthy. Coming with the part 1, in this we are going to understand the important terms related to the budget. During the discussion we will also attempt some of the questions that will help you understanding what kind of questions can be asked in the exam. If you have any doubt, any clarification required, you can please ask in the comment section. First term is union budget. So what is union budget? What is a budget? So budget, the term has originated from a French word bouget, and bouget means, this is pronounced as bouget, and bouget means you can say a bulgy leather bag. So you must have seen that finance minister most of the time they coming for announcing budget and they come with a leather bag, and that bag is always highlighted in most of the media reports in newspaper. So as if that bag is very important because that bag conveys budget. So directly coming to what is in union budget for us. So for us means when we talk about union budget, it is the most comprehensive document of the government finances, most comprehensive report of total revenues of the government, revenues from all sources, and total outlays. Outlays means where this money has been spent. So this is for the past year, and it also covers estimates of government account for next financial year. Say for in the budget of 2018-19, the budget we are discussing here. So it is a report of what government has earned and what government has spent during the year financial year 2017-18, which is starting from April 17 to March 19, that everyone knows, March 18, that everyone knows, report of this, and estimate of next financial year starting from April 2018 to March 2019. Now coming to this question, which of the following is a direct tax? Say that in budget it is all about the government's income and the expenses. The source of the income for government is primarily tax. There are two types of tax, direct tax and indirect tax. So can you answer this? Which of the following is a direct tax? Corporate tax, excise duty, custom duty, GST, or none of the above? You shall know what are the direct tax and what are the indirect taxes. Here I would like to tell you that at ixamBee.com we have a very comprehensive course for RBI Grade B. This course consists of 500 video lessons. These are small video followed by concept check questions. So you understand at the end of the video whether you have understood the concept or not. And the learning happens through these videos followed by questions. So there are total about 10,000 questions, MCQs, with answer explanation, which are going to reinforce your learning, and there is live doubt clearing sessions with the faculty. 2 to 3 classes are every week, which you can attend online sitting at your office or sitting at your home and directly interact with the faculty and other student in the class. If you are preparing for RBI Grade B, please go to the free demo at the description below and you will find a link for that video. Coming to the question, which of the following is the direct tax? So first you need to understand what are direct tax and indirect taxes. So direct taxes are those which are paid directly by the individuals and corporations directly. Directly means they pay directly to the government of India. Indirect taxes means they are collected by intermediaries. The person who is actually giving it to government of India is not bearing the burden of it. Say for example here, if you see the example that will make it very clear, income tax. You must be aware that there are different income brackets. Say somebody is earning 10 lakh rupees per annum. So he is paying close to 30% income tax on that. So that tax is directly paid by who is earning to the government of India. Compare this with GST. GST is a type of say sale tax or goods and services tax. So it is say you went to a restaurant and you have some food there. So this is collected by the retailer, the shopkeeper, the restaurant owner, the company, and paid to the government of India. But who is bearing the burden? The burden is with the customer. But Government of India is collecting directly from the customer? No. So that's why it is called indirect tax. Income tax is paid by individuals. Likewise, when corporations are there, so corporations pay tax on their income, which is called corporation tax. Now you can answer this question better. Which of the following is a direct tax? So I told you corporate tax is a direct tax. So excise duty, custom duty, GST, what are these? We are coming to that. Answer here is corporate tax. Corporate tax is called corporation tax also, or sometimes called as company tax. It is a direct tax on the income of the companies or other legal business entities. So it can be a company, it can be a partnership firm, it can be a LLP, limited liability partnership. So whatever type of business it is, the tax paid by the business is called corporate tax. Coming to what is GST. You all know full form of GST, goods and services tax. The difference between goods and services in economic, so goods is any kind of movable property other than money. It can be like crop, grass, house, car, food grain. And what are services? Services are like anything other than the goods. Goods are physical goods. So these are economic activities and these have value. Services have value. Say you go for haircut, you pay to the barber. So that is a service. He did some service, you paid for that. But you pay something to milkman for the milk. So that is where you are paying for goods. So service sector is big now, including say IT industry, healthcare, education. So it's big. So GST is a tax on supply of goods or services or both, except in case of alcoholic liquor for human consumption. So that is not coming under GST. Then about GST brackets etc. you shall read more. The another option here we learned is custom duty. So custom duty is a type of tax, or actually we don't use the term tax here, we call it levies. So levy charge on goods in case of the imported into the country, or in case of exports when exported from the country. So that is the levy charge on import export is called customs duty. Now I am asking one question before telling you the next term. Fiscal deficit minus interest payment is called as. So I want to introduce these terms: fiscal deficit, revenue deficit, primary deficit, basic deficit, monetary deficit, budget deficit, and all may not be actually valid terms. But do you know what is fiscal deficit minus interest? What is the right option here? Now let me first tell you what is fiscal deficit. So as I was telling, government earns, so government has earning and government has expenses. Government has earning from various sources, primarily tax, then it may be income from some PSUs. Government also sometimes take loans also, so that is an inflow. If it is not called earning, that is a inflow of money. So likewise there is expenses on payment of salary, developing infrastructure, road, railways, etc. When expenses are more than total inflow, that is called deficit, fiscal deficit of the government. Fiscal deficit is when government's expenditure is more than its receive. So you will say then how government will spend if it is not able to receive that much of amount of money? Government spends in say infrastructure, in military, you have to make payment, you have to buy defense equipment, salary of the government employee. So there are various expenditure, then other planned expenditure on various government scheme, and receipts for governments are like taxes, so income from say dividend in government companies, like government is holding stocks of various companies, so from there also some income come. So these are the income. When the expenditure is more than these receipts, the situation is of fiscal deficit. But which receipts? Excluding borrowed receipt, because whatever is the deficit, that will be made good by borrowed receipts. So expenditure will be then equal to receipts from non-borrowed items plus borrowings. So we can say expenditure over non-borrowed receipts. Non-borrowed receipt is called fiscal deficit, and to meet that, government has to make borrowing. Government borrows from the public by issuing bonds. Now you must be reading about different 10-year bonds, from 91-day treasury bill to 10-year, 30 years bond government of India issues. So that is the government's borrowing program to meet the fiscal deficit. What is revenue deficit? So revenue deficit is the difference between revenue expenditure and revenue receipt. This is the shortfall of the government current receipts over current expenditure. So for the year, for the financial year, say we are discussing here, say 2017-18 suppose. So during the year 2017-18, how much revenue government has spent and what is the revenue collected by the government. So revenue is not all receipt. So fiscal deficit is about the total receipt minus total expenditure, and revenue deficit is about revenue expenditure and the revenue deficit. Then comes the primary deficit. So primary deficit is fiscal deficit minus interest payment. So this is interesting to learn. Why you shall know primary deficit? Because this interest payment by the government, it happens for the loans taken for the earlier period. Say for example, Government of India borrowed usually from say World Bank or IMF or maybe other international institutions, maybe other government also. And why it borrowed? It borrowed, this is hypothetically I am saying, there is a borrowing but not that much huge in case of India now, but still there are good number of borrowings. So government borrowed because there was a deficit. Say 5 year, 10 year back there was huge deficit and government borrowed, but the interest payment for that is still happening, right? And that payment is counted as money outflow, and which increases your fiscal deficit. Normally what happens in case of the fiscal deficit? So fiscal deficit is created so that government spends more and it spends on developmental program. So in case of creation of fiscal deficit, if government is spending on developmental program by borrowing from the public, because whenever there is a fiscal deficit, government has to borrow more, I told that. If the borrowing happening and it is spent for the development purpose, so that is one type of fiscal deficit, but ultimately it will fuel the economy, it will help the economy as more money supply comes to the economy, right? But in this kind of situation, when the interest payment is very high, so the money is actually going for payment of the old loan by the government of the India. So primary deficit is the indicator of government's borrowing, or how much government borrowing are going towards meeting expenses other than the interest payment, because it talks about deficit. So it shows how much is going towards expenses other than interest payment. So I think you understood this well, because this is important to understand, because if lot of money is going for interest payment, the present economy is not going to get any benefit out of that, because that money has already been spent in the past. Now government is just paying the interest for that. So now this question is clear to you. Fiscal deficit minus interest payment is called primary deficit. Correct? Now coming to fiscal policy. So I told you about fiscal deficit. I will briefly tell you the Keynesian economy. So Keynesian economy said that government shall keep on spending more because it helps in fueling the growth. You can see that in the videos in detail if you are interested in knowing about the Keynesian economy, or you can Google it, and that became very popular after the Great Depression of 1930s. So fiscal policy is government action with respect to the aggregate level of revenue in spending. So government decides, say, how much I will spend against my receipt. How much more than, if the government is spending more than the receipts, it means that government is creating fiscal deficit for which it has to borrow from the market. So fiscal policy is implemented through budget, because budget is the document that tells the government spending and government inflow of the money, and this is the main instrument with the government of India, fiscal policy, through which it can affect the growth or development of the country or welfare of the people. So this policy is called fiscal policy. Now if you understand what is monetary policy, so you will be able to understand it better, because monetary policy is about the money supply in the economy. So who operates monetary policy? In case of India, it is RBI, Reserve Bank of India. So here the objective is to control the money supply, control the interest rate, because interest rate is cost of money. So today if you have to borrow from somewhere, so what is the cost of borrowing? So cost of borrowing is interest rate. So RBI influences interest rate and the quantum. So this is the price and this is the quantum. Money supply is the quantum. Say for example, if RBI increases CRR, cash reserve ratio, so all banks will have to park more money with the RBI and the quantum of the money supply decreases. And if RBI increases repo rate, the interest rate increases because the price of the money, the cost of the borrowing increases in the market. So this is monetary policy, and fiscal policy is with the government of India. So finance ministry actually is primarily responsible for this budget and fiscal thing in the government, but fiscal policy is owned by government of India. They decide how much to spend, where to spend, how much fiscal deficit to create, and monetary policy is with Reserve Bank of India. This is regarding money supply. Another important term is inflation. But before that, I asked this question: which of the following is not the objective of monetary policy in India? Price stability, economic growth, exchange rate stability, controlled expansion of bank credit, or all of the above are objective of monetary policy. So I have told you about monetary policy. So the right answer here is all are the objective of monetary policy, because price stability, which is measured by inflation, economic growth, though it is not directly stated, but ultimate objective of keeping good monetary policy is to help the country in economic growth. Exchange rate is about the currency exchange rate. So nowadays there are news that rupee is depreciating, so RBI is worried. RBI is trying to control that. And expansion of bank credit, I told you that if RBI increases CRR, so it can contract, it can reduce the amount of money supply, it can reduce the amount of bank credit in the market. So all these are objectives of monetary policy. Now coming to the term inflation, because how price stability is measured. So inflation is about general price level of the goods what we people are facing. So we say inflation, so inflation is always written in percentage terms, say 5%, 6% inflation. So it means that on an average, so when I say 5% inflation, it means that on an average the prices of the goods and services have been increased by 5%. So you will find two major criteria to measure inflation: CPI, consumer price index, and WPI, wholesale price index, to measure the inflation. So wholesale price measures the price at the wholesale level, and consumer price index measures price at the consumer level, you and me. Wholesale means when companies are selling to dealers and distributor at wholesale level. So this data is readily available. So this data comes first, and this data comes from the customer side, what price customer is facing. So if I say that wholesale price index is say 3%, so it means that every year at wholesale level prices are increasing by 3%. Now next term I want to tell you is capital budget. As the word capital is here, so capital budget is about capital receipts and payment, because when we say budget is receipts and payment. So it includes investment in shares, loans and advances by the government of India to maybe state government, government companies and others. So as I said, government of India holds shares of companies like Air India, different public sector banks, oil companies like Indian Oil. So these are there. Then government of India provides loan to state governments and also to government corporations sometime. So this capital budget takes account of all these receipts and payment. So payment will be when government of India puts more money. So like for in case of public sector banks, so now government is putting more money in terms of giving them more capital so that their NPA position can be better and their overall position can be better. So that is payment. And receipt is government is receiving income when the company is making profit, or by disinvestment also. I'll come to disinvestment. Before that, revenue budget. So revenue budget, again here the budget word is there, so it is both receipts plus expenditure, and revenue receipts are divided into two: tax revenue, non-tax revenue. So tax revenue, I told you, income tax, corporate tax, excise, customs, etc. And non-tax revenue can be like interest on loan. If government has given interest to someone, maybe sometime to some other countries also, or it can be dividend of government investment, government shares in some companies. So these are non-tax kind of revenue. Tax revenue is always the bigger part, and then expenditure. So this comes in revenue budget. Now there is a question: the bill produced after the passage of union budget. After the union budget, there is a bill passed. What is that bill? Monetary bill, finance bill, budget bill, revenue bill, fiscal bill. As I said earlier also, some of the options may not be relevant at all. There may not be some bill like finance bill. Actually, finance bill is the right answer here. There is not a bill like fiscal bill. So, finance bill is produced after the presentation of the union budget, and it details, finance bill details about imposition, abolition and regulation of taxes as proposed in the budget. I have already told the answer is finance bill here, which is passed after the union budget. Then important term is budget estimates. So as the term suggests, so this is the amount of money allocated in budget to any ministry, or for any project, any scheme during the financial year. Say for example, budget estimate can say that this year this much amount of the money will be spent on education, or this much amount of money will be spent on military. Then revised estimate, these are, as the name suggests again, these are the mid-year review. So mid-year, if any revision is there, mid-year review of possible expenditure, taking up the account of the rest of the expenditure, and these are not voted by the parliament. One question here, dash measures the development outcomes of all government, G shall be typed here, all government programs, and whether the money has been spent for the purpose it was sanctioned, including the outcome of the fund uses. So what is this called? Monetary budget, finance budget, outcome budget, revenue budget, consolidated budget. The answer here is outcome budget. Outcome budget has been introduced in 2006-07, and here every ministry presents a outcome budget or to the Ministry of Finance, and Ministry of Finance then compiles it. So this is what a progress card, that how much progress is done under various ministries with the outlay in the previous year budget. So last year suppose X amount of money is given to say HRD ministry. So they will present that as per the planning how much they could achieve, and likewise from every department, whether it is human resource or whether it is defense ministry, whether it is agriculture ministry, all this will come to finance ministry, and they will prepare a compiled outcome budget that measures the development outcome of the government programs and whether the money has been spent on the purpose for what the fund were allocated. Then one important process is called guillotine. So guillotine is a process because of the limited time parliament has. So speaker, you know, budget is passed first in Lok Sabha. You must have seen finance minister putting that budget in Lok Sabha. So Lok Sabha speaker puts all outstanding demands for grant, etc. in the vote of the house. So this process is called guillotine. Simply remember it for the exam, not much detail required. Consolidated Fund of India is all revenues raised by the government or money borrowed, because that is again an inflow, and receipt from the loan given by the government, any inflow. So all this flow into Consolidated Fund of India, and all government expenditure other than certain exceptional item are also done from Consolidated Fund of India. Contingency Fund of India, as its name suggests, so this is a fund placed for contingency time, and this fund is at the disposal of the President of India to make him advances to the government or executive to make some urgent requirement. So that is contingency fund. The name itself suggests contingency. Normal course mein, normal business mein, this fund is not touched. Normal business happens through Consolidated Fund of India. Then one important term, disinvestment. Disinvestment means sales of asset. So as I was saying, that is also one source of income for government if government is selling its shares in a public company, selling shares of public sector undertaking by the government. So this type of process is called disinvestment. So these are the important terms in this video. When we are discussing budget and economic survey, we will have more important terms coming in. We will discuss it then and there. Thank you.